All right. Good morning, everybody. Good afternoon if you're in a different time zone than us. Thanks for coming to the Tuesday Livecast. I'm here with Chrissy Jones. Chrissy is the president of our company and the financial wizard here. Today we have a special guest. We're going to get to him in just a minute. First, I would like to promote our our seminar that we're going to be holding in Boston on October 2nd through October 4th. We're hoping to be peak color season in New England. We'd love to see you there. If you haven't been to New England in the fall, you need to put that on your bucket list. This should be a great week. We had a wonderful turnout and a great session in San Francisco, and we're looking forward to doing it in October in Boston. So please go to our website, notemogul.com, notemogul.com, and search out our information on our seminar. So today we have a special guest. Markus Mollica is sales manager at TimeValue Software, and there are so many things that you can do with notes, so many opportunities to make money with them if you know how to use a calculator, and Markus and TimeValue offer some incredible ways to manipulate the financials of this, or to do calculations very easily. So we're excited to have him, and he's going to take us through. Now, this is going to be a 2-week presentation. Markus is going to go through some preliminary stuff at TimeValue today, show you how to use it, go through some schedules and so on. As the day goes, or as the Livecast goes on, he's going to get more sophisticated, more complicated with the software. And then next week, we're going to do some advanced strategies such as partials and so on. So let's get started. Markus, thank you very much for joining us today. People are very excited to see your presentation. So let's get going.
And thanks again to everyone that is joining today. And thanks to Ron Hoppy for providing me with the opportunity to present for you. Again, my name is Markus Mollica, and I've been here at TimeValue Software for 7+ years. I've been fortunate to work with many note investors over the last few years to help them with deal structuring and using TimeValue for their various calculation needs, whether it be calculating yields on their investment or restructuring cash flows, etc. I always enjoy working with individuals in this industry. It's just always fun and energizing, a lot of energy, and it just feels good to help individuals, I guess, make some money and figure out how to deal structure. Very often, with just a little training, investors are up and running with the basic understanding of using TimeValue. So hopefully I can do that for you today, and we always provide support and help with the product as well. So you could, if you use it, you can always reach out to me for some help. And TimeValue is a flagship product of TimeValue Software. It was originally created in 1984. Let me catch up my slides here just a second here. Just a little history on the company. TimeValue Software has been involved in the note industry, I'd say, since probably the late 80s, early 90s, and pretty much has come to be a standard in the industry. And I thought it was very interesting over the years of meeting some of the veterans in the industry that require that some of the individuals that do business with them have TimeValue schedules and use TimeValue for their calculations so that they're on the same page. So I always thought that was a compliment, very interesting. So today I'd like to show you some of the ways TimeValue can help you. I understand that TimeValue may be new to some of you, and I apologize if I go through quickly some of these scenarios. I'll do my best to slow down. But keep in mind, you can always call or email me with questions, and I believe we will have a recording of this webinar available to you as well. So with that being said, let's go ahead and get started. So the agenda for what I'm going to go over is kind of some basics to some creative, maybe a little more challenging things, but I think once you get a little hang of it, T-value, it becomes pretty easy. First thing, just verifying a note payment schedule that you have. So the original note, you might be buying it from square day one, or maybe you're a few years down the road. But what we want to do in this part here is just verify what the original note was, the terms, and make sure everything actually lays out the payments and the years tie out properly, and then we can make adjustments as need be. Then verify remaining note balance and or payments. You know, if you're partway through a note, or a few years into the note, what does that note look like now? If you're looking to go purchase it, and you want to know how that note stands at that point in time. Does the balance match the payments that are left, and do the payments match the balance? So you can be given information. It's just important to verify it and reconcile any differences. Then we'll do a couple workout scenario options with missed payments. So let's say the borrowers made payments for a period of time, and then they missed payments for a period. And now we want to know, what's owed at this point. What does the end of the note look like, and what can we do to bring it back on track? And then last but not least, is kind of a segue into the next session next week for partials, is calculating a pay price. So some might call it an investor's basis schedule, where you would be looking at cash flows and you want to determine how much should I pay for that. So we'll get into that just briefly toward the end, and any questions you have as well. So just to take a look at this first one, and let's say we'll call this Schedule A, which would be what the note payer schedule, or what that borrower is actually paying on. And like I said here, what we want to do is verify what the original note is. And in this example, the original note was $80,000. Interest rate is 6%, and the payment amount $479.64, and it's a 30-year term. So in this case, we have all the information, and one thing that's nice in T-value is that as long as you know 3 of the 4 variables, you can always back into the 4th. So and keep that in mind as you go through, because whenever you're trying to verify or reconcile a payment schedule, you only have certain information. Sometimes you may have to make an assumption to a certain extent, but as long as you know 3 of those 4 variables, we can solve and back into the other one. So the way I wanted to lay this out here, which I know many people are familiar with, just to show you, kind of lay out those variables, and then we'll input them in T-value. So here we have all 4 of them, the N being the number of payments, I is the interest rate, and PV for the present value. This is also, it would be synonymous for loan amount, or your pay price, etc. So those are kind of all commonly used terms meaning the same thing, and then also the payment. So what I'm going to do now is just take you over to T-value and just demonstrate how to input this. And for those of you that have not used T-value before, when you open the program, it's going to look, you're going to see a screen that looks like this. And this is going to be what you call a cash flow data matrix. This is where you would enter all of your cash flows of a loan or a schedule that you're looking to purchase. A tab over here is the amortization schedule. So this is where all the results will show up from the calculation that you're doing. You can customize the schedule to show information that you want. You can send it to Excel. You can send it to Word if you want to make some changes or add columns, etc. for different information you want to include. You can set up this schedule to meet different computations you want, whether it's a 360 or 365-day year, various compounding. So a lot of times we get individuals that are just really, kind of as we are in this first example, trying to tie out their matching payment schedule, and sometimes the interest might be off a little bit, and sometimes that's just due to a computation method or year length.
I mean, I think there's stages.
And it'll start with me up here in the label field. So what I'm going to do is just start here, and I'll go ahead and just put in Schedule A. And the best way to build a schedule in T-value is to build it sequentially. So when I press Enter or Tab in the program, it just kind of takes me step by step through the program. You also notice this blue text over here, which will give you some tips or pointers on what to do or enter in the field that you are highlighted in currently. And we're going to use monthly compounding, which we default to, but T-value has 13 different ways of compounding. So in most cases where you have monthly payments, that would be monthly. And then for our example, we have a 6% interest rate. So I'm just going to enter 6 in here. And just to show you briefly, TimeValue allows you to apply 4 different interest rates. We do the calculations for 4 interest rates. I know some people might use an effective rate. If you do, we can back into the nominal rate. And then press enter brings me down to line 1, which is a loan. And I can customize these event names. We're going to go ahead and use loan today. And then my date is going to be the origination date of the loan. And let's just, for example, let's just say this was July 1, and I only need to enter 6 digits to enter the date. Our loan amount on this scenario is $80,000. And the number refers to how many times the event on that line occurs. So that's just going to be 1. And then I'm going to go down to line 2, and it's going to default the payment. I click this drop down, you'll see that I have a few different options. If I were to increase the loan amount, or if I had a rate change at some point in time, I could apply that as well. And then the payment just defaults to a month later. However, any irregularities can be handled here. If you had loan date 6/15, first payment date 8/1, you could do that. So just apply the appropriate dates as they would be in the loan terms. Then what I'm going to do is type the letter U. So this says unknown, and that's the variable I want to calculate, or the variable I want to solve for in TimeValue. And then we're going to enter the number, which is 360, meaning 360 payments. The period here is the frequency of these payments, which would be monthly. And the end date 7/1 of 2045 would be the last payment in the loan. So once I have the variables in, I have my unknown in there, I go ahead and hit calculate. Populates my payment amount as $479.64. Click over to the amortization schedule, which is immediately done for you with a breakdown of your cash flow information, payment, interest, principal, and balance information for that schedule. So, in doing this, you can save this and then to your TimeValue folder, just as you would any Excel file or anything like that. However, you can only open it in TimeValue. So, but you can open it and you can make the adjustments down the line if a borrower missed payments, etc. Or you wanted to maybe throw some scenarios in there, some what-if scenarios. So now what I would want to do, just with this Schedule A or this original note is, maybe it has some different terms, for example. Let's say, for example, this one had a 20-year instead of a 30-year. All I need to do is put the number of payments that would be for the monthly payments in that. I can restore my unknown, and then I can recalculate. So now I have a new payment amount and a new amortization schedule immediately done. So what I can do if I'm looking at different scenarios also is I can save each one of these as scenario 1 or 2 or whatnot. Another thing is, let's say you had quarterly payments, for example, and whether it began a month later or say it was three months later, I can make that 3 months later for the beginning of a quarter, for example, and let's say that was over a 20-year period, which would be 80 quarterly payments. I got to make sure I changed my period to quarterly as well, so that shows the frequency of my payments. Still have the same end date as a 20-year, so that's easy to verify when you know what your end date is, maturity date, etc. I can calculate then the quarterly payment. So you have a lot of different ways to be able to verify these notes. Let me take this back. I want to show you an example that gets kind of into the little creative aspect of TimeValue. Let's move this back here. And let's say we wanted to do that loan had interest-only payments, for example. If I right-click on any payment line, you're going to access this dialog box here in what we call TimeValue Special Series. If I go ahead and click that, now I have this box that shows me a variety of creative deal structuring options I have in TimeValue, which I'm going to show you a couple here, but we're going to use interest-only. We also have amount step where you can increase the payment every payment or every year or every 6 months or something like that. You can also do that by a percentage. You can also use a monthly skip, which is a common used function that, let's say you had a borrower that wanted to start to pay the loan down even a little quicker, and maybe in December they wanted to make not just the $17.28 in this example, but maybe they wanted to make a lump sum payment of $5,000 or $10,000, or maybe they got their tax return. They wanted to put a lump sum down in April. You can put that in that month there'd be an increased amount there. interest-only payments. So I'm going to select the interest-only tab, make sure I check the box there. And now it's going to say interest-only in the amount field. The T-value is going to calculate that for us. Then I just put in the number of payments that will be interest-only. So let's say there are 12. Payment resumes, then the next payment or next month. And then when we want principal and interest payments, we want to make sure we put our unknown value in there. And then another important aspect here in calculating this is to put, whenever I calculate principal and interest payments, I want to make sure I put either the full term, the amortized term, or the remaining number of months. So in this case, they had 12 interest only. They're going to now have 348 payments left on a 30-year term, for example. And then I go ahead and hit calculate, and now I have my payment amount, principal and interest. I click on the amortization schedule. I now see my payments, which is going to interest and 0 to principal for the first year, and then our principal and interest payment throughout the schedule. Some scenarios, even if you had a balloon scenario, and I'm going to show you in just a little bit how to accelerate payments. Let's say in this example, maybe you had a balloon in 10 years, let's say. So if you had 12, you're going to have another 108 payments. Then you're going to have a balloon. You can make an unknown for one payment at that 10-year mark. I can even move this back a month. We have some shortcuts in T-value. I'm not going to go through all of those today, but easy way to enter dates and amounts, etc. Then I can calculate that, and I'll have my balloon payment, and that will be adjusted on the amortization schedule. So some different ways of tying out original note that you have terms and making sure that everything is as it is set to be. Let me take you back to these slides quickly. And then what I want to do now is just go to it in another scenario. And you're going to see how easy this can be once you understand some of the basics. And in this scenario, let's say, for example, maybe it's not the original note that you're buying. Maybe you're a couple years down the road. They've been making borrowers been making payments for a while. And let's say you need to verify the remaining number of payments. The seller's giving you a balance at this point in time, and they're telling you how many payments are left. I'll tell you just from experience, I worked a lot in the banking and credit union industry for this term called trouble debt restructuring. And it's very similar to doing workout scenarios for non-performing notes where borrowers have financial difficulty and the banks would restructure the loans. Well, I would talk to these individuals and they would kind of seem like they guessed, say, well, this is the balance and there should be this many payments left. Once I back in T-value and verify that, they might be missing anywhere from 3 to 6 payments in the loan. So it's important to make sure you're verifying that information. Excuse me. So we'll use the same scenario. So let's say we're 36 months into this loan. And then we have a balance that the seller's given us of $76,867. And what we want to do in this example is verify how many payments are left. Again, if I lay this out to know what variables I'm going to solve for, I'm going to solve for n being the number, and here are my other 3 variables. So let me take T-value. And I'm going to go ahead and hit new and bring up a new schedule. You can have up to 15 schedules open at one time and just toggle back and forth between them. Label this also schedule A again. We know the interest rate is 6%. And let's say we just took this 3 years back. One of the shortcuts to T-value is hold down the shift key. I hit the letter Y for year. It'll take me back, let's say, 3 years. And then I'm going to enter in what I'm told the balance is at this point. So $76,867.26. 1 is the number. And then assuming, okay, our payments are $479.64. And what we want to do is verify how many are left in this note. So, put in our balance, our unknown variable is the number, which is the number of payments. Easy enough, I just go ahead and click calculate. Populated with 324 payments left in that note. Amortization schedule, I immediately created as well. Now, sometimes on an original note, you might have an in this case would be a little bit different, potentially, where a loan would be calculated for 30 years, and that last payment might be a little different, 20 cents or 30 cents or 50 cents. Sometimes there's a rounding amount that in most cases is negligible, but you can always verify what that amount is in p-value. Here it's 26 cents. So if it's less than maybe $1 or something like that, you're going to have a little bit of a rounding. So you can apply that to a particular payment or the loan amount. So as you can see, very easy to do to verify what those remaining number of payments would be. Another situation which is pretty similar, but I just want to lay this out in the slide to kind of show you how it looks with the numbers before you input the schedule. So how do I verify the current balance? So again, it might be several years down the road. I'm going to use the same scenario here, and information that I have 3 of the 4 variables, which I'm going to input into t-value. My unknown is going to be my balance or loan amount or present value, whichever you want to call it here. So it would all be that loan event. So I'm going to lay that one out like this, and the present value or the loan amount is going to be my unknown. So let's go back over to t-value. And I can use the same scenario here since we have the same cash flows. And basically, and you're going to see how easy this is the important thing really is just entering in the correct cash flows, the amounts, and the appropriate dates that apply. So, and assuming, even if this were, let's see if it doesn't really matter what the dates are, as long as they are sequential and match. And say this was so 7/1 loan date. So let's say we were looking to purchase this last month, and these would be my payments. Again, my unknown is going to be my present value or my loan amount here. I have my other 3 variables. Hit calculate, and you get $76,867.19. So in this case, there is no rounding, and oftentimes when you do a present value calculation, you won't have the rounding because it's going to be accounted for in the payments and terms. But if when I did the calculations and solving for the number, I had a little bit difference in the rounding. Most of the time it's negligible. It's just to let you know it's there. You can always verify that in the rounding. Okay, very good. So now I want to get into something that's going to be, a little bit more tricky, I guess, than doing the basics. Which is how do I verify the balance with missed payments? And this can get tricky, but as long as you know the amount, you know the dates, and even if you weren't sure, maybe how many payments were missed, but maybe you knew the balance, or someone gave you, a seller told you how many payments were left. Like I said, if you know 3 of the 4, you can back in to the 4th variable. So in this case, the scenario is 48 months into the payment schedule. The borrower has missed the last 36 payments. So they've essentially made the first 12 and they missed 3 years in a row. And what does this loan look like now? And what are our options? What are the things we can do? So then I want to basically show you how to calculate the balance at this point in time. You can add the forbearance to the back end. So you can either have the borrower pay up front. Maybe you can add the amount that they owe and add it to the back end, which is going to accrue interest. There's going to be a lot of decisions that you're probably going to make in doing this. But another example would be creating a workout scenario where I might either, if they can't pay it up front at that point in time, maybe I can give them 6 months or 12 months in order to make a higher payment in order to get back on track. Or one of the scenarios would be to create a step-up scenario where maybe they start at, let's say, the $479 payment, and every 12 months they maybe increase that payment $100. With the second year, they're making $579. The third year after that, they're making $679, etc. So I'm going to show you some ways to get creative in doing that. Okay, so back at t-value, and I'm going to lay out this schedule here from day 1. So let's say this was back to 3 years. So my interest rate, 6%. Our date, one of the shortcuts, holding the ship and hitting the letter Y for years. So let's say this was actually, let's say 4 years ago. And we will put in what that amount was originally, 80,000. And let's say in this scenario, as we said, they made, so the payment was before 79.64. Let's say they made the first 12 payments. Then after that, beginning 8/28 of 2012, they made 0 payment. They made that 36 times monthly, which brings us to 7/28 of 15. So now, what do we do? What is that balance at this point in time, or what do they owe essentially? So what we can do here is, if this was going to be 479.64 at this point for the rest of the loan, and assuming this was a 30-year loan, they had 48 payments. There would essentially be 312 payments left. One thing I think is always good is to verify my loan origination date with the end date. It's 30 years. I know my dates and inputs are correct. So in this scenario, one thing you might do is, one we said is, what if they paid what they owed right now before they move on? I can right click on this line, select expand, and now what it does is spread out all my cash flows where I can then come in to these cash flows and do various calculations. So in this, let's say we made unknown on 8/28, say, hey, if you pay this amount now, then you'll be back on track with your loan, $19,700, but maybe the borrower says, oh my gosh, that's too much, I can't afford that. Well, maybe I can break that into 3 payments or 6 payments, where then that borrower then can pay a lower amount for a period of time, and then they'll be back on track with their normal payment with the original maturity date without having to extend the loan. So that provides options for them. You can get creative, you can extend it longer. One scenario that I'm going to show you here is to do step-up payments. I'm just going to change these variables back real quick. And go ahead and sort this back together. So what I can do by right-clicking on this payment line, I'm going to apply what we call our amount step and T-value. So again, I'm going to go into the special series. I'm going to click on this amount step tab, and I can activate this here. But really what I want to do is this borrower starting out at the 479 payments, and we want to increase that by, let's say, $100 every 12 payments. And what does that look like? So originally, now this is going to shorten the term of the loan. So instead of them paying for the next 312 months, I'm now going to solve for how many months it's going to take to pay off this loan with that amount step, that $100 increase every year. So if I hit calculate, now you're going to get this box occasionally for rounding, and essentially what that means is this amount here, the 366, is a little bit different than what the payment amount is at that point in time. Here we have an amount step, so it's going to be higher than this. Whatever it is, we can add it to that last payment, or we can create a balloon or the payment in itself plus a month of interest. So let's say we just add it to that last payment. What does that look like? Well, that accelerated the loan from 312 payments down to 139. And if we look at the amortization schedule, we can see our cash flow information. As we scroll down, we can see there 36 months of missed payments. Now they're back on track. So first year, 479, second year, 579, 679, etc. throughout the schedule. So again, you can get pretty creative here. You can, that amount could be whatever you want it to be. You can, do a percent step if you wanted to, and it's a way to just be flexible and try to make things work out for both you and for a borrower in that situation, and get that loan performing in the event of this with missed payments and it's not performing. So I know I probably went through these fairly quickly. I just want to show you one more example here, and then if we have some questions, we can go to the questions. But one of the scenarios I just want to show you is, because a lot of times people ask, well, how much should I pay for the cash flows? How much should I pay for the notes? Let's just take a look back here real quick. And this all depends on, there are going to be a lot of variables, but I think the one thing is every investor has hurdle rates or desired yield that they expect or want on the cash flows that they purchase. So the first question would be, what kind of return do you want? What yield do you want on the cash flows you're purchasing? Some individuals may say, well, 10% is good for me. Others may say 15%, 12%, whatever that is. That's going to be that's going to give you an idea of how much you should pay or show you specifically for a certain yield what you should pay. It doesn't take into account what would happen in the future on that loan if someone misses payments, et cetera, or if they happen to pay it down sooner, your yield's going to go up. So it's just something to look at as an overview and know, what are your criteria. So again, I'm going to apply this into the same example that we had. Let's say you're looking at 3 years into the note, and with our balance of the $76,000 at that point in time, and this is what you might call the investor basis schedule. So it's going to basically look like this. Our desired yield or our unknown is going to be the unknown is going to be our present value. So we're going to have to determine what this is. So let's go to T-value for this last calculation. Again, I'm going to go ahead and enter this in here. Let's say that your desired yield is 10%. Our unknown is going to be the present value or my pay price. Payment amount of the cash flows are $479.64 or $324 left. So in order for me to get a 10% return on my cash, I pay $53,000. That'll do it for me, and that'll give me a 10% return on these cash flows. In a perfect world, that borrower makes this payment on time for the next 324 payments. My desired yield was 15%. Very easy. Just change the interest rate, change my unknown, and calculate. Now I'm down to $37,000. So this is something to consider, and as I said, it's kind of a segue into doing the partials, because this might be where you're looking at purchasing at a certain yield for yourself, and let's say that you were, and we'll go into this next week, but if you pay $37,000 for these cash flows and you turn around and get an investor to give you $37,000, maybe they want a lower yield or something like that, it costs you almost no money to get into the loan, and you're only showing some partial of what you actually purchased. So let's just go ahead and summarize and close out this presentation for you. And again, if you have questions, feel free to reach out to me. I always like to throw this in here. I know a lot of individuals use Excel and they use HP handheld calculators, and I have plenty of customers that do it. These are some of the things that kind of give you an advantage by using T-value. So and just a summary, what we did here is created a Schedule A to verify original note terms, determine the balance with missed payments and or remaining number of payments with the balance, did some workout scenarios, and learn how to calculate your pay price or your purchase amount on cash flows that you're looking to buy. So with that being said, do we have any questions?
Thanks, Marcus. We don't see any questions coming through at this point, but I would guess that over the next week or so, we may have some. So if anybody has any questions, you can email them to info@notemogul.com, and we will try and address them next week for the second half of this.
Okay, and if you have any questions directly related to me, my information is here on the screen. Feel free to give me a call or shoot me an email. I'd be more than happy to help anyone out.
Great. Thank you so much for your time. Talk to you next week.
Thank you.
Thanks, everyone.